When people talk about compound interest, they usually describe it as a miracle, the eighth wonder of the world, the secret to becoming wealthy, the key to financial freedom. And mathematically, there's truth in that. But there's something rarely discussed. The same force that builds wealth over time can also quietly destroy it. Compound interest is not inherently good or bad. It is a mechanism, and depending on how it's used, it can act as a financial lever or a double-edged sword. In this video, we're going to break down both sides, not with hype, not with promises, but with clear, evidence-based reasoning. Because understanding this distinction may be one of the most important financial insights you can have. What compound interest really is 0.50 to 3 o'clock. At its core, compound interest is simple. You earn returns. Those returns are reinvested. And over time, they generate additional returns. It's growth on top of growth, mathematically. It's exponential. But here's the key point. Compound interest does not care whether it is working for you or against you. It applies equally to investments, savings, debt. That neutrality is what makes it powerful and dangerous. Compounding as a financial lever 3 o'clock to 7 o'clock. Let's first look at the positive side. When used correctly, compounding acts as a multiplier. 1. Time amplification. If you invest consistently over decades, your early contributions become disproportionately valuable. Money invested earlier has more time to compound. This is why starting early matters, not because of the amount, but because of duration. 2. Capital efficiency. At some point, your returns begin to exceed your contributions. For example, if you invest regularly for years, eventually your portfolio might grow more from returns than from new money you add. At that stage, your capital is working for you. 3. Reduced dependency on labor. As assets grow, they can begin generating income. Dividends, interest, capital appreciation. This can reduce reliance on active income, not eliminate it necessarily, but reduce dependency. 4. Behavioral advantage. When people understand compounding, they tend to adopt long-term thinking, less trading, less speculation, more consistency. This behavioral shift alone can improve long-term outcomes. The other side, compounding against you. 7 o'clock to 12 o'clock. Now let's look at the part most people ignore. Compound interest does not only build wealth, it can also compound debt. 1. High-interest debt. Credit cards are a clear example. If a balance carries a 20% annual interest rate, and it is not paid off, interest is added to the balance. Then interest is charged on that new balance. This is compounding, but in reverse. Instead of growth, you get acceleration of debt. 2. Time works against you just as early investing helps wealth grow. Early debt accumulation can become more damaging over time. Small balances can grow into large obligations if left unmanaged. This is why minimum payments can be misleading. They may prevent default, but they often extend the life of the debt significantly. 3. Negative compounding through fees. Compounding also applies to costs. High fees in investment accounts reduce returns year after year. Even small percentage differences can significantly impact long-term outcomes. This is sometimes called negative compounding. 4. Inflation as silent erosion, inflation compounds too. If prices rise consistently, the purchasing power of your money decreases over time. This is not always visible in short periods, but over decades it becomes significant. Why it feels like a double-edged sword, 12 o'clock to 15 o'clock. The reason compounding feels contradictory is simple. It amplifies whatever system it is applied to. If your system is consistent saving plus investing gives compounding builds wealth. If your system is debt plus high interest plus poor cash flow gives compounding increases pressure. It doesn't change direction on its own. It magnifies direction. The timing problem, 15 o'clock to 18 o'clock. One of the most misunderstood aspects of compounding is timing. Early on, growth is slow. Later, growth accelerates. This applies to both assets and liabilities. That means if you delay investing, you lose time advantage. If you delay addressing debt, you increase long-term cost. Time is the common variable. Common misconceptions, 18 o'clock to 21 o'clock. Misconception 1. Compounding guarantees wealth. It does not. It improves probability over long periods, but outcomes still depend on consistency, market conditions, behavior. Misconception 2. Higher returns always mean better compounding. Higher returns usually mean higher risk. Volatility can disrupt compounding. Large losses require larger gains to recover. Misconception 3. Debt is always bad. Not necessarily. Some forms of debt can be manageable or strategic, but high interest, uncontrolled debt is where compounding becomes harmful. How to use compounding safely. 21 o'clock to 24 o'clock to make compounding work for you. Prioritize eliminating high-interest debt. Start investing early. Even with small amounts, invest consistently over time. Keep costs low. Avoid unnecessary complexity. Maintain a long-term perspective. This is not about maximizing returns. It's about controlling direction. Structural thinking. 24 o'clock to 26 minutes and 0 seconds. Instead of asking, how can I get rich faster? A better question is my financial system aligned with positive compounding? Because over decades, small differences in direction create large differences in outcome. Conclusion, 26 minutes and 0 seconds to 27 minutes and 30 seconds. Compound interest is not a shortcut. It is not a guarantee. It is not a secret. It is a force, a neutral one. It can build wealth slowly, quietly, and consistently, or it can increase financial pressure in the same way. The difference is not in the math. It's in the structure behind it. And once you understand that, you stop chasing returns and start managing direction.